you don't want to be too attached not only to your own personal BS, but sort of too attached to a particular theory of the world, even though all your instincts are going to want to go that way, because that's how you know, if you have a framework, you can seem smart and logical. But you've got to be willing to kind of get outside of your comfort zone and, you know, acknowledge that we don't really know all that much.
Hello and welcome to the fourth episode of the Drayton Discourse, brought to you by the Economist Society here at UCL. My name is Yash.
And I'm Vanderica, and we are thrilled today to be joined by American macroeconomist and former board member of the US Federal Reserve, Professor Jeremy Stein. Professor Stein's profound research spans from behavioral finance to corporate investment, financial regulation to monetary policy. He served on the Board of Governors of the Fed from 2012 to 2014. In 2009, he also served as the senior advisor to the Secretary of Treasury under the Obama administration and was part of the National Economic Council.
His distinguished career has also propelled him on the academic front. He has taught finance at MIT and is currently the chairman of the Department of Economics at Harvard University. So without further ado, let's straight get to the interview.
So, Professor Stein, to begin, we'd like to ask you some questions regarding the current news and your research. So, you have served on the Board of Governors at the Fed following the global financial crisis in 2008. And given your experience and your profound research in finance, what are your thoughts on the Fed's current response to the COVID-19 crisis? And I think our audience would also like to know how can this current response can be compared to the response in 2008?
So first of all, just on their current response, I mean, I would give them very high marks overall. They've been, you know, they've learned the lessons in some sense of 2008, 2009. They've been very aggressive, very quick to respond. I think Chair Powell in particular has done a very good job of communicating and being extremely forthright about sort of the magnitude of the problem and the uncertainty. So, and then when you think of specific responses, some of this has been clearly informed and shaped by the experience of 2008, 2009. So very early on in March, they rolled out a set of programs, some of which were aimed at essentially calming short-term, what you might call money markets or funding markets, and were very similar to what was done in 2008, 2009. They also, a little bit later, also in March, rolled out these programs that were basically going to buy corporate bonds. So they have this thing called the primary market credit facility and the secondary market credit facility. And those had, at least in the short run, a sort of really quite extraordinary impact because the bond market was in quite a bit of disarray. They introduced these things and bond prices really stabilized. The sort of credit spreads on bonds narrowed substantially, even just by virtue of the announcement. So it was a little bit magical because they didn't really go out and buy a whole lot at the beginning. In fact, they didn't really buy much of anything, but just sort of the message that they were there not only stabilized the markets, but allowed companies to then issue in the private market quite a bit of new financing. So investment grade companies raised enormous amounts of new financing. High yield companies raised quite a bit. So all that was to the good. So now questions going forward. So there's still a lot of stuff to worry about. One is this bond buying program that I talked about, which has had this sort of miraculous effect of calming the market without them having to do anything. And this is central bankers have this, and this is a little reminiscent of Mario Draghi saying whatever it takes several years ago. Now, when you say whatever it takes, and somehow you manage to get all this thing without actually buying anything, you need to wonder a little bit about what's going on. And I think one way it works is you say, well, I'm not going to buy today, but you somehow convince the market, I've got your back. If things really deteriorate, I'll be there. Well, so this raises a question, if we have a second wave or if things, deteriorate further and there start being a lot of downgrades, let's say, or bankruptcies of some of these companies, to what extent are they really willing to step up, it's kind of hard for them. It's one thing to say, I'll buy investment grade bonds. It's another thing to buy those bonds when they get downgraded or when the companies in question start to default. But if you think about what's propping up the market, you might worry that to some extent it's not the idea that you're going to buy them when they're in good shape, it's that you stand ready to buy them when they're in bad shape. And so that remains an open question. And I think, if I were there, I'd be thinking very hard about exactly under what circumstances are they willing to buy sort of distressed companies. Okay, and I think this is, now we're getting to the fundamental difference between 2008, 2009, and now, is that at least with hindsight, and with hindsight and with a lot of good luck, you can say that 2008, 2009 was largely what you might call a liquidity crisis. So, what central bankers have this basic idea that the lender of last resort, the basic kind of function of a central bank, and this goes back to Bagehot in the 1800s, who was a sort of observer of the British, the Bank of England, that what a central bank is supposed to do is lend to fundamentally solvent but illiquid banks, okay, at a penalty rate and without limit, and the idea is you're going to get your money back. So, in a classic sort of bank run, right, the underlying assets of the bank are okay, but they just don't have enough money today. You lend into that, you break the back of the bank run, and then everything is okay and you can get your money back, okay? So the basic idea is you're not taking a whole lot of risk if you do this well. And that, again, very, very loosely has some echoes of 2008, 2009. So for example, the US government put out a tremendous amount of money to the banking system, got paid back in full. Got paid, okay, I don't want to understate the fact that it was lucky, but at least in hindsight, that makes it look a little bit like a liquidity problem. I don't think that's the nature of this crisis. There's just enormous uncertainty. And if you say to yourself, I'm only going to put out money, think about it, there's enormous uncertainty about how long the virus will be with us, when there'll be a vaccine or some other resolution. Even post the vaccine, there's a great deal of uncertainty about the reshaping of the economy. What will airlines look like? What will travel, hotels, all? So we just don't know. And so if you say to yourself, I as the central bank or I as the government, I'm only going to lend if I'm pretty confident I can get my money back. That might have been a way of addressing 2008, 2009. You won't be addressing this, if you lend only to high investment grade firms. So this is at the heart, in some sense, of the test that's facing. Is if things deteriorate, I think, it's very likely that at some point there's going to be a real sort of wave of incipient defaults and bankruptcies. And to what extent are they willing to really get involved and lose money and have the government, it won't be the Fed, it would be the Treasury Department, but lose money. So that's one of the big open questions, big differences. The other thing, and the one place where I would sort of fault the Fed, I think they've made kind of an unforced error, has to do with sort of how they're dealing with the banks. So one of the big lessons last time around is we were too slow. So between 2007 and Lehman Brothers in 2008, US banks paid out over $130 billion to their shareholders as either dividends or share repurchases. In other words, they were letting capital go out the door at the same time as this, the situation was getting much grimmer. And they weren't raising new equity. They didn't really get around to raising new equity until 2009, until the so-called stress test in 2009. That's a lesson that I think we should have learned, that when you start getting into the situation of very high uncertainty where the tail risk looks really quite bad, you want to start conserving the capital of the banking system and, if anything, building it up. And unlike UK regulators and regulators in a number of other countries, US regulators have allowed banks to continue paying dividends. They haven't kind of pushed them in the direction of raising new equity. That's the one place where I feel like they're really meaningfully kind of behind the curve.
Thank you so much for your answer. It was very detailed and very interesting. So in 2011, you wrote a paper for the Journal of Economic Perspectives in which you discussed the use of macroprudential policy to regulate the financial system. Mm-hmm. And in the context of COVID-19, what can macroprudential policy teach us?
Okay, so actually that's interesting. That's really sort of going to bring us right back to this previous point about the banks. So, let me start by just trying to define what macroprudential policy means. And maybe it's easiest to define it by contrast to what you might call Macroprudential, which was the prevailing kind of attitude towards financial regulation prior to the GFC, which was basically this. We don't want banks because there's deposit insurance. When a bank gets into trouble, we don't want it to stick the government with the tab because it has to be bailed out by the deposit insurer, right? So if they have no capital and they have a lot of deposits and they go bust and their liabilities are bigger than their assets, we don't want the government to have to pick up the tab, okay? So if that's your view of the world, we like banks to have capital. And, so you have some capital regulation in that world. And you're quite attentive to the capital ratio, okay? Which is essentially, roughly speaking, it's the ratio of how much equity they have to their total loans, their total assets, okay? And importantly, if they start to get into trouble and, their assets start to decline in value, you tell them, well, you need to fix your ratio, okay? Now, very important observation, kind of obvious, ratio has a numerator and a denominator. And there's sort of two ways that a bank that's in trouble can fix its capital ratio. It can either get more capital, that is, it can try to raise new equity, or it can stop paying dividends, or it can shrink. It can have fewer assets, so it can either increase the numerator or decrease the denominator. Okay? And in the Macroprudential world, you don't really care. You just don't want the deposit insurer to lose money. And in particular, one way that you're happy to have this happen is sort of a Darwinian thing, where if you have an individual troubled bank, it just shrinks. It starts lending less and less and less, and so your exposure as the deposit insurer is going down. And I guess you figure, it's a Darwinian process, and it'll shrink, and some bigger, better other bank will take over its customers, and that's fine. Okay? So Macroprudential is agnostic on whether you keep the capital ratio up by shrinking or by raising the capital. So what the Macroprudential view, again, in light of sort of all the problems in 2008, 2009, kind of takes on is, well, you care about something else. You care about the banking system being able to supply credit to the economy. And if every bank is fixing its problems by saying, well, I don't want to raise equity, I don't want to dilute my shareholders, so I'm just going to shrink. I'm just going to lend less. That may protect the deposit insurer, but it kills the economy because, of course, there's just less credit supply. So what I would define as the essence of the Macroprudential approach is that you're also attentive to sort of overall credit, okay? And then that tells you that if you think about this ratio, public policy has an interest in not having everybody shrink. Well, then what's the alternative to kind of keeping this? Then you really care about dollars of capital, okay? You start asking yourself, how much is sort of the total amount of capital in the banking system, because that relates to the total amount of credit that they can supply. And that brings us back now to this point of it becomes very important to, when we start getting into a really sort of stress crisis situation, individual banks are still going to want to pay dividends to their shareholders. Individual banks are still going to be resistant to raising new equity when their stock price has fallen by 30 or 40%. They're going to think it's dilutive to their shareholders, but public policy has an interest in basically pushing against that. Okay, and that's I think one of the main messages. And even if you start out with, as we now are, with a somewhat healthier banking system and higher initial levels of capital, as things start to deteriorate, it's very important to sort of take these kind of capital preservation measures. Again, cutting off dividends, promoting new equity issuance. And I thought that was a very clear lesson from last time. And I think, again, regulators around the world, to some extent, I feel, have internalized this lesson. I've been disappointed in the Fed, and that I think they could be considerably stronger on this thing. But that's, we're worried about, to put it, more concretely, imagine that there is a vaccine and the economy is ready to sort of come back. Well, to support that, you're going to need credit supply. Other parts of the credit supply mechanism have been damaged. You need a strong, well-capitalized banking sector at that point for us to be able to kind of rebound and do the investment and hiring and all that. And that's what we want to be attentive to now, and not wait for things to get worse before we deal with the problem.
Thank you. Thank you so much for that answer. And it was extremely insightful to know that about central banks. And now moving the discussion from central banks towards governments and nations. So the large fiscal stimulus packages being announced by governments around the world are going to have a huge impact on public debt, like you said. And nations are looking at novel ways to finance this debt now. And most recently, like the European Commission was discussing the possibility of a carbon tax to do so, or even taxing like digital taxes, like revamping the digital tax system. So, in your opinion, what are the long-term implications of this high public debt, and how can countries finance it effectively?
Okay, so as you kind of framed it, there are essentially two distinct questions in there, right? One is, can we essentially manage? Will we be okay? Can we manage this kind of debt load? And the second is what's the best way to raise tax revenues? And I think they're a little bit separate, and carbon tax in particular, because I think the carbon tax has many merits that are sort of independent of the level of debt. In other words, for any level of debt, we're going to have some taxation. And then you can say, well, what's an efficient way to raise taxes? A given amount of tax revenue. And of course, you try to do it in a way that's least distortive. You don't want to tax like good things like effort and initiative and all that. And you do want to tax bad things like pollution. And so, carbon tax, this is what's called sort of a Pigouvian tax. You're not doing it just to raise revenue. You're doing it to sort of correct an externality. So I think there are many, many arguments for carbon tax. Those all, in some sense, predated COVID. So let's sort of check the box that's a good idea. And then now let's sort of turn to the second question. Are we going to be able to manage? So particularly a specific way to put this question is, like for example, in the U.S., we are likely to have debt to GDP of well over 100% when all is said and done. And that's sort of often thought of as a kind of scary number. And what's going to happen to us with that level of debt. So I think whether it's a problem or not is going to depend a lot on what economists sometimes call R star. So what is R star? It's sort of what's the level of interest rates, it's sort of it's sometimes called the natural rate of interest. It's like, what is the level of interest rates that we sort of need to have to keep the economy not too hot, not too cold, okay? And in recent years, it seems like this R star has been declining. So, because inflation has been low, even with a pre-COVID, relatively robust economy, people have estimated that R star has declined fairly substantially. So if that holds, in other words, if it just so happens that nature delivers for us a world in which inflation can be kept in check with real interest rates that are near zero, well, then we're going to be lucky, and it's pretty easy. It's pretty easy to service a debt burden, even a large debt burden, when interest rates are zero. Okay, so in that case, which it may, for all I know, be the baseline case, we'll be better off than it might at first seem with large debt levels, just because interest rates are going to be low. Okay, the scarier scenario, and again, it's hard to put a probability on this, but the scarier scenario is, for reasons we don't necessarily know right now, this R star could go back up. Or said a little bit differently, there could be inflationary pressures coming from one thing or another. So, for example, if you think of what this pandemic has done, it's like a giant supply shock and a giant demand shock all in one. And it may be that in the short run, it's more of a demand shock than a supply shock. So in the short run, it's probably a little disinflationary, if anything, right? Because people are staying home, they can't go out, they can't buy stuff, so we're just basically saving more of our income. That's deflation. It may be that when the virus has passed to some extent, so this is just a hypothetical scenario, so people are kind of back and out and shopping and doing everything, so demand has come back, but supply chains have been recast in various ways, okay? Because of fears of future pandemics, whatever, we're not sourcing as much stuff from other countries, we're doing more stuff locally. That is less efficient. That's a little bit like a supply shock. If that stays with us, that could have, over a longer run, some kind of inflationary impulse. In that scenario, there would be a need, all else equal, for the Federal Reserve to raise interest rates to combat inflation. Then it gets trickier, right? Then it's tougher, because then there's a tension between raising interest rates and doing what you should be doing to combat inflation versus, boy, it's pretty hard to sustain those higher interest rate payments when you have debt to GDP of 100% plus. So that's when it gets worrisome. That's when you can start to ask, kind of troubling questions about what will the Fed's independence be? They've sort of gotten involved. They're going to have a very large balance sheet if they raise it. So the question is whether they'll have the independence, given their large balance sheet, to be able to raise interest rates. So again, the short answer is whether the debt burden turns out to be a problem depends a lot on sort of the future course of inflationary pressure, which is a little hard to foresee.
Okay, well, thank you so much for that. We'd now like to steer the discussion towards unorthodox ideas that have been discussed and taught in recent economic and financial circles. So these ideas may be something that our generation builds on and that our students would be really interested in hearing from the perspective of a renowned policymaker such as yourself. So, for instance, American politicians and economists such as Stephanie Kelton have been advocating the use of a heterodox macroeconomic tool, which is modern monetary theory. As a monetary policy expert yourself, could you briefly explain what MMT is and perhaps share your thoughts on it?
Sure. So I'll try. I will say I've tried to understand, and I've done some reading and watched a number of the sort of presentations on MMT. I find it still a little slippery, so I will take my best shot at it. But I think the first point that MMT proponents basically make is, don't think of the government like a household. U.S. government is different because unlike a household that borrows and then has to pay back, the U.S. government is borrowing in its own currency and it can always make more. Okay, so somehow, back to the question about debt, if it finds itself very indebted, it can always essentially print money to pay off that debt. Okay, so that's true. Okay, so that first premise is surely true. We are borrowing in our own currency and we can make more. Okay, so there's no disagreement. Now, the next point, which I think takes a leap, is to say, therefore, the only real problem, the only thing that can go wrong is that you get too much inflation. In other words, and you'll see in a second sort of where the rabbit goes into the hat, but because we can always print money, okay, we can always get out of a problem. Of course, if you print too much money, you might have inflation, but the leap is to say the only thing that can really go wrong with too much government debt is inflation. Okay, next little leap is, well, look, we see other countries like Japan with very high government debt and no inflation. We don't see inflation on the horizon here, certainly. So if the only thing that can go wrong is inflation and we don't see inflation, then we have room to do more. And again, I'm not sure I'm characterizing it exactly as an advocate would, but the idea would be, look, we seem to be in a kind of very low inflation environment, so there's clearly room to do more, and we should stop basically when inflation starts to rear its head, or we might want to think about stopping. Right now things don't seem to be problematic. Okay, so let's think about what happens when you have a large debt. Okay, there's basically three things that can happen. So I owe you guys, I'm the U.S. government, and I owe you something. Okay, the first thing is I can honor my debt. Okay. How do I honor my debt? Let's think of a real economy. I gave somebody else a bunch of hamburgers by borrowing the hamburgers from you, so I got to pay you back. So I'm going to have to get those hamburgers and give them to you. How do I do that? By raising taxes. So one outcome, obviously, of a high government debt is painful levels of taxation on future generations. Okay. Alternatively, if that's too painful, I could not pay you one way or another. How can I not pay you? Well, one is I could outright default. I could just repudiate the debt and say I'm never going to pay you. Okay? The other is I could inflate it away. That's another way. Inflation effectively makes the real value of the debt lower, so I'm not giving you quite as many hamburgers. Okay? So again, there's three ways that high debt levels, there's sort of three sorts of pain that high debt levels, this is just accounting, right? One of three things has to happen. Either you borrow a lot today, either you got to pay it back by raising taxes, you've got to stiff the debt holders by just not paying them, or you've got to have inflation. I think that's just, that's the realm of possibility. What MMT is effectively saying, and this is again where the rabbit goes into the hat, is that you will choose to do that via inflation. So we don't really need to think about these other two, okay? Now that's empirically just not true. So my colleague Ken Rogoff has done this very interesting research, and they've documented a number, I think it's like over 60 cases, where countries outright defaulted on their sovereign debt in their own currency, right? So they don't need to. So this is kind of the key point. In other words, MMT is right to say, in principle, you don't need to default because you could have always printed more money, yet they've chosen to. Why is that? Well, because these other options aren't all that great either. High inflation can be enormously destructive in societies, right? And by the way, once you start having a lot of government debt, investors get worried and they won't lend to you on a very long-term basis. The government debt starts being pretty short maturity. So you need a tremendous amount of inflation to inflate it away. And given the choice between hyperinflation or very high inflation and default, sometimes countries choose to default. So you're starting to, the basic point is, is that high debt can be painful. The other thing is you can honor it. You can honor it by, imposing very high taxes on future generations. That's also painful. So my basic point being, just because there's the one option is inflation, that is not always the option that's chosen. And as a result, inflation, I don't think, and certainly currently observed inflation, is not the sort of be-all, end-all summary statistic that you should be looking at. So I think it does make sense to worry. Now, I don't, I'm not a debt phobic. I think it surely makes sense. It undoubtedly makes sense in a crisis like this to be aggressive in borrowing. And in fact, the policy errors that have been made in the past have been shifting to austerity often too soon. So we shifted to austerity too soon in this most recent crisis. That happened in the Great Depression as well. Fiscal policy got tight too soon. So I'm not advocating certainly in a cyclical sense for being tight. But I do think it goes too far to the other extreme to sort of say, even in normal times, we can borrow kind of pretty freely and just sort of say there's no bill to be paid. And I don't know, that may be over characterizing the views of MMT, but I think sometimes in the public discourse, they have a little bit that feeling. And that's the thing I think.
Thank you so much for that answer. And you spoke about inflation as an issue, right, in finance and economics. Now, recently, with other issues in development and climate change coming up, growth as an economic ideal has come under heavy scrutiny. So in finance, we've seen new ideas cropping up, such as, evergreen direct investments, that are EDIs, and demurrages, to shorten time horizons and catalyze, in a way, a shift away from this obsession with growth. So in your opinion, are there any such major structural changes in finance that we can expect in the future? And if so, what are they?
So this is a hard question for me. In the sense, I'm a terrible futurist, and it's hard. But I mean, I would almost work backwards and not think of finance kind of leading the structural change, but following it. In other words, I think it's easier to sort of be confident that we're going to see some, very significant changes in the real economy coming out of the pandemic. We talked, just briefly about, you can imagine certain industries really being kind of reshaped. I also think there may be quite significant implications for sort of how we live and work. So, for example, I think a lot of companies are discovering, we're discovering, these Zoom things work pretty well. And maybe instead of going all the way to London, it's kind of efficient to do this. Many companies are figuring I can have workers work at home at least some of the time. Think of what this does, for example, to the demand for office space. If you can have an office that's half the size, commercial real estate could take really, fairly significant hit. All that stuff. So there's going to be just a lot of real restructuring. And I imagine that, one of the challenges for finance is going to be rising to help essentially effectuate that. So, a lot of bankruptcy, a lot of reorganization. Can we have bankruptcy procedures that are more efficient? all that kind of stuff. Beyond that, I don't know if I have the imagination to think about some of the more futuristic stuff.
Thank you so much for that. It's true that there have been many cultural shocks due to the pandemic.
Yeah.
So at this point of the interview, we'd like to ask you some personal questions.
Okay, sure.
So you have worked at the Fed, like you've mentioned before, but also at the Secretary of Treasury under the Obama administration. And currently you work as an academic at Harvard, and you have also worked at MIT.
Mm-hmm.
So what have been some of the key learnings throughout your career?
Well, one way to answer that is to sort of think about, academics who become policymakers or who sort of try to transition into policymaking. And my colleague Larry Summers had a great line about this, about academics who go into policy. His dictum is, don't fall too in love with your own BS, which is, we all have our favorite theories, and they're all well and good, but when you get into a policy-making setting, the world is more complicated than your simple models, and you need to be more just heterodox, more eclectic in how you view the world. And I'll give you sort of one example of this. I found this very interesting in my time on the FOMC, the policy-making body of the Fed. As you know, there's a whole bunch of people, 19 when we're at full strength, who kind of go around and are voting members of this committee. And what was interesting to me, and there's a number of them who are like me, who are academics by background, and a number who are more real world, like someone like a Jay Powell, who came from a combination of government and private equity background. It was very interesting in that you often saw the academics occupying the extreme poles of the debate on one side or another, okay? And I think there is a temptation, if you think about, I'm gonna make this sound a little abstract, if you think about a world and you just don't know what the right model of the world is, right? The right model of the world could be, we call it model A or model B. What's the right way to be a good decision maker, right? The right model of the world could be, the Keynesian model describes the macroeconomy, and the other could be something else, okay? The right, I think, normative thing to do is not to be a model picker, not to say, I believe this is the truth, or I believe this is the truth, but to say, how can I make a decision that will be a good decision in the case that I don't really know, that I have some uncertainty about? What's a decision that's sort of robust to the fact that I don't really quite know? Academics, oddly, who should know better, who should be better kind of decision theorists, I find tend to be more model pickers. In other words, those of us who are trained at MIT have one model of the world. Those of us who are trained someplace else have a different model of the world. And we like to argue from those specific models. Why? It gives you, this is what we're good at. If you have a framework, you can be very articulate, very coherent, and everything hangs together logically, but then you kind of want to stick, it's a sort of a matter of comfort to stick to your framework, okay? Whereas then there are folks who I think by just sort of, disposition are a little bit less attached to a particular model, better at taking input that comes on many different frequencies. It doesn't always make you the best debater, right? Because now you're taking a little of this and a little of that, and the thing becomes, but it often makes you a better and sort of more resilient decision maker. And one of the things I learned, one of the people I thought was sort of a master at this was Tim Geithner. He was just sort of intellectually kind of eclectic. And he listened to academics, he listened to real world people, and it made, again, he didn't make him necessarily always the most articulate in defending a particular point of view. And it's not what you would do if you wanted to make yourself look the smartest at any point in time, but it's really sort of the right way to think about policy. I think Jay Powell has some of that as well. I was very impressed with how some of the non-academics on the FOMC often were quite good at bringing together sort of the more extreme poles of debate, if you will. So, I thought that was just sort of one of the interesting lessons about trying to make the transition, again, from being an academic to a policymaker. And it's sort of what Larry said. You don't want to be too attached not only to your own personal BS, but sort of too attached to a particular theory of the world, even though all your instincts are going to want to go that way, because that's how you know, if you have a framework, you can seem smart and logical. But you got to be willing to kind of get outside of your comfort zone and, you know, acknowledge that we don't really know all that much.
So, well, actually, your reference to your experience at the Fed brings us to our thought experiment, which is really a signature of the interview. So, if you could take over the Fed for a desired period of time and implement any policy, structural change or the like, what would you want to implement?
Okay, so I won't try to boil it down to a very specific policy, but I'll sort of talk about it in terms of a broad structural thing. So I guess I would like to, and this has been happening, but I would like to push on sort of better integrating the two sides of the house, if you will, being monetary policy, broadly speaking, and regulation, financial stability on the other hand. So, you know, to step back before the 2008 financial crisis, it would have been a bit of a caricature, but not totally unfair to say, essentially, you know, when people thought of the Fed or thought of central banks before 2007, they thought, oh, these are the guys who set interest rates, right? It was all about, and if you read, you know, there was this famous book by Bob Woodward about Alan Greenspan called Maestro. And it was all about Alan Greenspan as like this guy who was brilliant in thinking about exactly what interest rates should be to sort of steer the economy, right? So the sort of image we had, and it was, you know, true to some extent, was there's monetary policy, that's in the penthouse, and there's bank regulation, and that was in the basement, you know? And yeah, sure, we regulate, but it just didn't get the attention. And I think everybody in hindsight feels like, you know, that we were not sufficiently proactive and attentive on all that. Now, the good news is, the very good news is, you know, regulation and financial stability is not in the basement anymore. It's clearly, you know, become a front and center thing. But I think what you could say is that while it's not in the basement, it may be in a different building. It may be in an equally nice building, but it may be in a different building in the sense that the two sides of the house have different intellectual traditions, different, you know, people, different skills, and they don't really speak the same language. Okay, and it seemed to me during my time there that many of the most interesting, important, kind of compelling issues have to do with the intersection of those two. That, you know, sure, one way to deal with financial stability is entirely with regulation. But, you know, sometimes monetary policy has a role to play. Or sometimes not even interest rate policy, but what the balance sheet looks like. And can the balance sheet be complementary? Can the Fed use its balance sheet in a way that's complementary to its regulatory objectives in terms of financial stability? So, and again, I felt like those discussions were often quite separate. Again, there's a sort of regulatory side of the house, and we didn't sort of take full advantage of some of the intellectual synergies there. Now, in fairness, I left there in 2014. They have made, I think, substantial progress on that. But I guess, you know, that's the first thing I would sort of revisit. And some of it's structural, some of it's cultural, some of it is literally probably having the people who are the stars on one side of the house spend some time on the other side and getting to appreciate each other's sort of issues. But, you know, to me, the essence of central banking really is that these two things interact in sort of important ways.
Thank you so much for that insightful answer. And now for the final question that comes from our audience. And the context for the question is that, you know, bailouts has been a very contentious issue during the pandemic. So in a viral CNBC interview, venture capitalist and billionaire Chamath Palihapitiya argued that the Fed should let bad companies fail, you know, as profits are spent in share buybacks and distributed among shareholders with not much saved for the rainy days. So in that context, Matteo asks us, should the Fed let bad companies fail or should it prop them up?
So this is one of these questions where it's all in the framing. It's all in the framing. In other words, what does bad mean? What does bad mean in this context? So here's an important point. Normally, I think we sort of make an equation, a loose equation of financial distress with economic non-viability. So bad is bad. In other words, you know, normally if I tell you outside of the pandemic, well, here's a company that, by the way, has had near zero revenues for a long time. It can't service its debts, so it's clearly in financial distress. You would say, yeah, that's probably a pretty crappy company and it should be Darwined out of existence, right? Because we think that that financial distress is telling us something about its real kind of economic value add, okay? I think this crisis, I mean, and this comes back to something we were talking about before, almost a signature of it is this is a case where financial solvency may be quite divorced from sort of long-run economics. So let's take a few examples. So my dentist, okay? Normally I go to the dentist and get my teeth cleaned every 3 months because I'm pretty good about oral hygiene and all that. Okay, I didn't go, and I'm guessing many people basically skip dentist appointments, and so dentists are going to be very financially, the gym, lots of other places are going to be pretty financially challenged. In some cases, if they had debt, or even if they didn't have debt, they may not be able to pay their lease. Okay, are these bad businesses? I'm pretty sure, I don't know about hotels and airlines. I'm pretty sure like there's a role for dentists. I'm pretty sure there's a role for like colonoscopies and mammograms and all these things that just weren't getting done. And if you had a mammogram facility, you were probably hemorrhaging cash. But these are not things we want to liquidate, right? And so, but this is why it's so hard. And there are things that we are going to decide we do want to liquidate. So it may be that like chain department stores are permanently going to, lose ground to online retail. Well, what's your policy? I mean, you can take, if your metaphor, if the ones you're thinking about are the department stores, you can say, I don't want the government to put any money in. And this is why it's just so hard. And I think, this sort of lender of last resort philosophy that you only want to lend to, quote, good companies that you're sure, if good means sure you can pay back, that's pretty rough. That's pretty rough. And then you're going to get a big wave of bankruptcies. And the bankruptcy process, by the way, not super efficient even during normal times. We know there's some quite good research which suggests that there are real, just like with hospitals, there are real capacity sort of congestion problems in the bankruptcy courts. So even in a garden variety recession, when bankruptcies go up, the bankruptcy process becomes considerably less efficient in terms of just recovery rates for creditors. And if you do nothing in this scenario, we could have a sort of historic wave of bankruptcies. Again, some of them will be the so-called bad companies that need to be restructured. Some of them may well be good companies. Some of them will be just small businesses that really don't have a sort of restructuring option and just tend to get liquidated. So, gyms, nail salons, restaurants, all of that. Again, many of whom will be viable in the long run. So I think it's trickier. And I don't mean to dismiss the fact that a lot of this, it's going to be a very blunt tool to give some aid. Will surely end up giving some aid to companies, at least for some time, that would have been better off terminated. But I think that's the world that we're in. So I tend to be much more sympathetic. I mean, I sort of accept that basic premise in a normal recession. Or surely with sort of idiosyncratic troubles. This is, again, it's sort of distinctive in the sense that there's the divergence between financial distress and economic viability. This seems to be sort of an experiment in making those as far apart as possible. And so some of the usual rules of thumb, I think, don't apply quite as easily.